Hi there, and welcome to another episode of The People of Private Capital. I'm Ferdy Roberts, CEO and founder at Asset Class. Check us out at assetclass.com. We provide a range of software solutions for the private capital space. So if you are in venture capital, private equity, an RIA, somebody operating in the family office space, a wealth manager, we have a range of solutions to help you digitize your firm and improve your relationship with your investors. On this episode, I speak with Nick Rosenthal, the co-CEO at Griffin Capital, an investor in the multifamily space, amongst others, a major player in the qualified opportunity zone space in the US. And we have a far-reaching conversation covering QOZs, the impact of the big, beautiful bill, and a great deal more. Check out this episode here with Nick. It was a great pleasure to speak with Nick, to learn more about this exciting space, understand some of the challenges that have been faced in recent years, and indeed some of the opportunities coming up in the years ahead. Sit back and listen to Nick Rosenthal from Griffin Capital and enjoy this episode of the People of Private Capital podcast. Okay, well, Nick, first of all, thanks very much for taking time out of your busy day. It's just after Labor Day weekend. You're back at the office a number of hours, as I understand it, probably way before the East Coast, although you're on the West Coast. Thanks very much for joining us here on the People of Private Capital podcast today.
Ferdy, great to be with you and appreciate your time as well.
Yeah, likewise. Well, we're going to dive straight in, Nick. As the title says, we are focused on the people of private capital. And so as part of that, what we like to try and do is understand firstly a little bit about the people, and in this case, yourself, a little bit about your background. So can you give, just for anybody who's listening or watching, the audience, just a sense of who you are, where you're from, and kind of how you got to where you are in a relatively pre-seed form?
Yeah, sure. Happy to. I live today in Newport Beach, California, although our offices are up here in LA in the South Bay. I came to California in 2005, but I guess I'll start with sort of my journey to California. I
Right.
grew up in Boston, and when people ask me where I'm from, even today, I start with Boston because if you're a
Right.
Bostonian, it's kind of in your blood, and they don't let you come home if you don't claim your roots. So I grew up in Boston in a suburb called Brookline, Massachusetts.
Right.
I am the middle child of three, the only son.
Right.
My father was a lawyer, my mother a writer. So
Right.
I was kind of taught at an early age how to argue and how to do that in an articulate way
Right.
using proper grammar.
Yes.
I had a great upbringing. Was in a wonderful household and was fortunate enough to go to school, kindergarten through 12th grade, at a place called Milton Academy, which really had a pretty formidable impact, I think, on my life. Looking back,
Yeah.
really taught how to think critically. Was surrounded by people much smarter than I was, and just a great community that I still kind of look back upon very fondly. And then from there, went to George Washington University,
Yeah.
and that was a good experience, a different experience. City campus, as you're probably aware, in Foggy Bottom. But
Mm-hmm.
what I liked about my time in DC was just surrounded by a lot of energy, whether it was politics, journalism, business climate, and had opportunities over sort of that part of my life to have different internships, which were interesting and different, and really exposed me to a business environment. So after I graduated from George Washington University, I headed west, and I had moved to Southern California for a number of different reasons, but predominantly I had a lot of my peers that were either going to law school or going sort of the investment banking route. I
Right.
really didn't want to do either. I thought I wanted to be a lawyer sort of my whole life because my father was a lawyer. And then in the time I was graduating, it was a pretty uncertain economic environment. I got the sense in talking to my father that being at a big law firm was a tough environment at that time, and that maybe I should take the opportunity to do something totally different.
Right.
And I was dating at the time my now wife, and she was an engineer, mechanical engineer, was going to go back to Southern California where she grew up for her first job out of college. And I decided to follow, and it was the best decision I ever made for a variety of reasons. But
Right.
today, we celebrated our 15th wedding anniversary last week. We've got two
Oh,
beautiful
congrats.
boys. Yeah, thank you.
Yeah.
And I've built sort of a career and life for myself on the West Coast, which has been great. So,
Yeah.
I still think fondly of the East Coast and get back there often. And it's really Boston is where I grew up and in many senses home, but have a life and a home here on the West Coast in Southern California now.
Yeah. Yeah. Great. And so you moved out there in, it looks like, was that, as part of you moved to Core Realty? Was that the kind of the first major?
Before that, actually, so
Okay.
my first job out of college on the West Coast was working for a Sino U.S. developer. So we were
Right.
based in L.A. and we had projects in China, and China had just been accepted into the World Trade Organization,
Great.
was looking for foreign investment capital. The principals of the business had relationships in China from having done a bonded warehouse deal there in the 80s, and embarked on a very ambitious project to build an 1,800-acre industrial park. And that was my first exposure. So I had the opportunity actually to go back and forth between Southern California and China, where we had our projects ongoing. And then from there, I ended up on the acquisition side of the business. So
Yeah.
uh, it was a bit of a different journey as I described, but a great experience right out of school.
Yeah. And how did you get involved in that? Like, what was the catalyst for, I mean, that's a pretty significant
Yeah,
move straight out of college, right?
like all things, you just start talking to your network,
Mhm.
and it's about my career, particularly sort of every stop I've made. I could tell you it's been about relationships and relationships opening up opportunities. So, knew somebody who's on the board of directors of this company, was able to leverage that into an interview. They needed sort of a junior analyst, and that was the role I slotted into. So
Yeah.
when you're young, you're out of school, beggars, can't be choosers. And it was a different opportunity, an interesting opportunity. And so I jumped on it,
Yeah.
commuted every day from Newport Beach to the port of LA, and swore I would never do that again when I stopped doing that. And here I am commuting from Newport Beach to LA again. But it was a great experience out of school.
Yeah, yeah. And a very interesting time to be involved. I mean, there was certainly a period of time in the kind of certain mid to late 2000s, and I guess again in the 2010s, where China, featured large on a lot of firms' agendas in terms of potential, not just sources of capital, but a place to deploy capital. What was the I guess the nature of the investments that you guys were looking at there?
Yeah, I mean, we were really a diversified private equity shop, but
Mm,
the anchor investment that brought us over there was an 1,800-acre industrial park, and the
yep.
thought process was we were effectively going to create a small size modern industrial city.
Right.
And I mean, if you think about an 1,800-acre project, it had a school, had a healthcare facility, had dormitories, and actual distribution manufacturing facilities. So it was highly ambitious, and this was a project that sat right between Nanjing, the old capital, and
Right.
Shanghai, in a small part of Jiangsu province. And then from there, we looked at other investment opportunities because, as you articulate, I mean, at that time, China was welcoming foreign investment. There was all
Yep.
sorts of ambitious master plan growth opportunities. We looked at break bulk port deals. We looked at Western housing for these European and American company executives that were going to have to be housed over there. And so it turned into more than just a industrial park strategy. But that was really the anchor project at that time. But I came back for a variety of reasons. One, I missed being home.
Yeah.
Two, we were undercapitalized, and that was becoming apparent to me. And so I really became at that point interested in deal structure, because from that experience, what I took away is you could have a great idea and great access, but if you don't have appropriate structure, then you don't really have anything. And so I went to work on the acquisition side of the business, underwriting multifamily, multi-tenant office, and industrial deals.
Right.
And so, took away from that sort of the concept that deal structure mattered, wanted to understand it, learn deal structure. And then I got that experience in my second stop.
That was with Core, was it?
Yeah,
Yeah.
yeah, and really backed by a wealthy family office investor, and this component of the business was acquiring and syndicating investments for the predominantly the tenant in common space,
Yeah.
which has now evolved into a completely different structure. But my job was to source and underwrite acquisitions, predominantly multifamily, but also a little bit multi-tenant industrial and office.
Yeah. Yeah. Okay. And so it looks like you moved from, Core into KBS.
Yeah.
Is that right? Yeah.
So we went through a pretty significant disruption in the capital markets environment. And at the time, we had been effectively CMBS borrowers, and that market just turned off overnight.
Yeah.
And
It was an interesting that was '07 to '09. That's a pretty interesting period to be
it was,
to be involved in it. Yeah.
and again, I learned a lot, Ferdy. I mean,
Yeah.
you see how things can devolve and where risk lies,
Yeah.
and that was a education for me, super additive to sort of the way I skeptically look at things today.
Yeah.
Just from the framework of, okay, everything looks good today, but what could go wrong, and when
Right.
things go wrong, how do you deal with them? And if you put certain structures in place, how do you navigate around those issues? But, I was sort of looking at my career at that time, and because we weren't acquiring, I was going to potentially wear more of an asset management hat, which was not that interesting to me at that time. So
Right.
I had a relationship from somebody that effectively became a mentor to me over time. And he really had tremendous success on the distribution side of the business, raising capital for investment management firms.
Right.
And at that time, KBS had just come into the wealth management space. Predominantly, their capital formation had come from sovereign funds, pension plans, endowments, insurance companies.
Right.
And they viewed this opportunity in the wealth space. And the folks that really had experience in distribution in the wealth space at that time were folks who had come out of the insurance side of the business. So
Right.
you have think about sort of the old annuity sales
Yeah.
professionals, MetLife and Equitable. They had a lot of success raising capital for institutional investment managers who had then built product for the wealth management space. They had effectively seen that opportunity in alternative private markets, started with real estate, and took KBS into the wealth space. They
Right.
didn't have folks with traditional real estate backgrounds, though. And
Mhm.
so the thought process was that I could come over with my real estate background and help be sort of a bridge between real estate and wealth.
Right.
And ended up transitioning most of my time to the wealth side of the business and capital formation. But at that time, I had no concept of the fact that capital came from the wealth channel, who the end investor was, even though when I was sitting at my previous employer doing deal structure work, that's who our investor base was. But I,
Right.
as acquisitions person, didn't really interact with that side of the business that frequently until really the end.
Mm.
And so, it was a real education for me understanding the wealth channel. But I had that real estate background that helped me speak differently to that marketplace about what we were doing and why we were doing it and how we were doing it. So
Right.
it was a great transition.
And that was, I'm sure, just knowing a little bit about Griffin right now, it's probably an interesting primer for. So you moved in, looks like 2015 into to Griffin from KBS. Is that
Yeah.
right? Yeah.
Yeah,
So
and,
what was that transition like?
yeah, I was very fortunate. So, Griffin was starting a business that was a parallel business to their existing business, and Griffin had history and roots in the wealth space, had built strategies and distributed strategies for the wealth space. But we're getting into the registered fund part of the market, which was a new structure, a completely different investment team, and they wanted to stand up a separate distribution business for those strategies. And I was really intrigued. I mean, I thought operationally, the structure had tremendous value to folks in the wealth channel, the ability to acquire something with a ticker symbol, to sell it with a ticker symbol, to
Mhm.
have transparency of daily valuation. And as the wealth channel was evolving, I viewed that opportunity in 2015 as to be really a first mover, with a firm that understood the channel, but was building a product with a team that was going to really be a bit innovative at the time. And so I saw that opportunity, and I was fortunate enough to end up on that team focused on those strategies. And it's really interesting how these things happen. I had a good friend who was happy where he was sitting at the time, who was approached to interview for the position that I ended up having.
Right.
And he said to the person interviewing him, "I'm not your person, but you should talk to Nick."
I know the
And
guy who is.
yeah, and I
Mm.
was lucky enough to meet this person who was jumping on a flight. He was helping to build out this team, and he was in the middle of all of this frenzy. And he said, "I'd love to meet with you, but I'm flying out of John Wayne Airport at this time on this day."
Mhm.
And I said, "You know what? I'll come meet you at the airport, and we can sit on a bench outside of security." And
Yeah.
uh, that ended up being the start of a relationship today with that individual that I value tremendously. Uh, but that's what led me to Griffin, and
Yeah.
I feel very fortunate to have been sort of early in that process when that business launched and got scale and saw it evolve. And now, if you look across the private market space, every large investor and investment management firm has a registered fund strategy. So
Yep.
we were fortunate to be innovative and first movers, which is sort of the history of Griffin. And I was on the ground floor of that phase of our growth, which was terrific.
Yeah. That's, yeah, well, timing is everything in these things, and, yeah, as you say, the network, the power of the network. So just for people who are unfamiliar with Griffin, can you give a sense of, let's say, the scope of your interests right now, and the markets that you address, and maybe on the flip side, the propositions that you're putting out there to your distribution partners?
Yeah, so our business has evolved over 30 years. So
Mhm.
celebrating 30 years today,
Mm.
and historically was a direct real estate business, private offerings, tax-driven strategies across different sectors of the real estate market. Had once upon a time formed and launched a office and industrial REIT vehicle, which spun out in 2018. Co-sponsored a healthcare real estate investment vehicle, or a series of real estate investment vehicles, and they're now publicly traded. Our job in that arrangement was really capital formation and investor services. We had joint ventured with a fairly large healthcare real estate investment manager in order to formulate that business. Uh, in 2014 and 15, when I joined, we had just started a registered fund platform, which was a private public real estate strategy in one vehicle. The other was a corporate credit vehicle. But effectively, we sold the registered fund business to Apollo in 2022.
Yep.
And so we've gotten smaller. So over the course of the history of the business, we've raised $17 billion of capital through our partners, invested $300 million of our own alongside of that. We've sponsored $23 billion of investment strategies. But today, in sort of that post-Apollo world where, again, we're privately held independent firm, we decided after we sold the registered business to really focus on the rental housing segment of the market based on our view of housing affordability issues and long-term demand drivers that we think are going to be very sticky and
Yep.
our ability to generate good risk-adjusted returns in that part of the market. So today, that portfolio is a little over 40 investments across multifamily and student housing. It's a little over 12,000 units in total, 29 states in which we're actively invested. And we are standing up in a couple of weeks a build-to-rent business. So we've lifted
Right.
out a couple of executives from where they were previously to run that vertical within our firm. So a diversified rental housing investment management firm with a variety of different strategies based on our view of entry point, whether it's buying assets that are stabilized or developing assets ground up with joint venture partners. But
Yeah.
we'll take a look at the market and make a determination about where within the market we are comfortable deploying capital, and then we'll build fund structure around that for our partners to participate alongside of us.
Right. Yeah. I mean, it's just it's incredible the breadth there, and yeah. I mean, the sheer scale of your interest is impressive. You guys operate in the QOZ sector also, right? Can you
Yep.
talk a little bit about that?
Yeah, so we are one of the largest opportunity zone fund investment managers, and that strategy, as I articulated earlier, is really a rental housing investment strategy.
Hmm.
And based on the construct of the regs within opportunity zone fund investing, it's really a build to core strategy where we build assets and then we lease them to stabilization, then we manage them post stabilization for extended period of time. So long duration investment view with that strategy, and been fortunate to raise $2 billion of capital in that space since we entered it in 2019. That's about $4.5 billion of total project costs across our investment activity there. And we execute that in joint venture with some of the largest developers across the U.S. So folks like Greystar, Mill
Yeah.
Creek, Alliance, Fairfield, and others. And so yeah, that's been a great place for us to attract capital and deploy it in a way where we see sort of an intersection between not just capital formation, but great outcomes within the communities in which we're investing. So
Yeah.
if not for that program, I don't think a lot of the housing that has been built over the last 5 years would have been built. And what we all know as investors in the housing market space, that in order to create affordability in that part of the market, we need more supply. So as interest
Hmm.
rates were going up, as capital availability was contracting, as operating costs were escalating, a lot of small and mid-sized developers were pushed out of the market. But because of that program, there was really consistent access to capital, both on the equity and debt side,
Yeah.
which has allowed us to be active.
Yeah. Probably, I'm sure helpful that the the one big beautiful bill act and I guess some permanence to the OZ proposition is helpful, right? In terms of building your longer term perspective on that. It wasn't clear exactly what was going to happen in that for a while, right?
Yeah, that's right. And I think for our stakeholders, having that clarity is also terrific. I mean, it
Yeah.
is a great tool for solving problems for investors and for communities. So
Hmm.
when you look at just the success of the program to date, I would have been hard pressed to come up with a conclusion other than that this wouldn't be renewed in some way, shape, or form, given the policy objectives of the current administration in terms of housing. So,
Yeah.
uh, we have been very active over the last 5 months, spending time with lawmakers, their respective staffs in the House and the Senate, and lobbyists trying to craft this component of the bill in a way that creates consistent capital formation opportunities and it really meets the intended objective of directing capital into communities to create socioeconomic mobility.
Yeah. Yeah. And just kind of speaking of the, let's say, the midterm view, I mean, how do you see that market, let's say, a couple of years out here? It looks like supply is still reasonably heavy in 25, but starts are decreasing. How do you see that, let's say, 27 horizon kind of looking, and how is that kind of feeding into your strategy right now?
Yeah, and that's the right question, Ferdy. I mean,
Mm.
whether it's the Opportunity Zone Fund or any other investment strategy, first and foremost, it's an investment. So, what do the fundamentals look like? What does the outlook
Mhm.
look like? What is a reasonable base case? And on a risk adjusted basis, are you comfortable with that, right?
Yep.
I think when we look at the last couple of years for real estate investors in general, it's been extraordinarily challenging. And you know, I make the joke that a lot of real estate investors will tell you how great they're doing and how well capitalized they are. Uh,
Mhm.
and if you're talking to real estate investors over the last couple of years, I'm not sure that would be an honest reflection of their reality. So,
Yep.
as you can imagine, interest rates going up, availability of capital contracting, just capital rotation in the private markets, moving heavily to things like private credit and to
Yep.
private equity out of real estate, which is a more interest rate sensitive sector. Uh, all of those things have made it more difficult. Inflation has made it more difficult because you've got operating costs that have increased, things like payroll, insurance, even taxes.
Yep.
And the dynamic is that when interest rates were low, we didn't have any of those issues. So everybody was a developer. You could
Yep.
go to your country club and capitalize a deal with 80% debt and 20% coming from your buddies, right?
Yep.
Passing the hat around. And so what we found was small and mid-sized developers were very active at that time. There was plenty of capital to go around. So we saw record levels of new starts because post-pandemic, we saw a tremendous amount of household formation. So
Right.
everybody was moving to different places across the country. If you had roommates, you were moving out. If you were living at home, your parents wanted you out, or you wanted to get away.
Yep.
So we just saw all of this renter household formation post pandemic, low rates. Everybody saw that opportunity, drove hard towards it. And now, 2.5 years later, you've got record new supply hitting the market.
Yep.
The good news is you also have phenomenal demand. So when you
Mhm.
look at population demographics, you look at affordability issues, these are all big tailwinds for demand in the rental
Yeah.
housing market. Uh, at the same time as interest rates were going up, what I described about capital being abundant completely shifted. So new starts dropped off dramatically. And so what we see occurring is new deliveries as we get out into the second half of this year, 26, early 27, are down 60, 70% in a lot of sort of the core markets that we see.
Yeah.
So absorption is now positive in all major markets, which means the demand side of the equation is there and we know the supply side is dropping off. So from
Yeah.
our perspective, it's actually a really phenomenal time to be deploying capital, whether you're doing it in 25 or doing it in 26. I'm not sure it's going to make a tremendous difference, but over the intermediate and long term, I think investors that are deploying capital over the next 18 months are going to be rewarded fairly handsomely because it's very clear that we have strong demand, we have persistent affordability issues, and we do not have a lot of new supply coming. So we likely to see operational tailwinds, certainly as we get out into the second half of 26. If you get some rate cuts on top of that, potentially you'll see a lot more rotation quickly back into private real estate. That will be supportive to valuations. But as we sit here today, valuation indices across all sectors of the property markets have effectively troughed. We're starting to see green shoots in some markets in terms of fundamentals improving. But,
Yeah.
all of the headwinds I described of the last couple of years are going to create the tailwinds of the next couple of years. So
Yeah.
it's been a slog, will continue to be a slog until we get through all of this new supply. But very clear opportunity once we get past that into the second half of 26.
Yeah. Yeah. It's great to hear that after, a couple of very tough years, for various players in the space. But yeah, I have to agree, and we're seeing it amongst our client base. We're obviously pretty active across a range of different asset classes, and that's what we're hearing. I think it's cautious optimism. There's still a bit of work to be done, but I think green shoots is a good way to describe it. Just talking of investors, you mentioned investors there. I'm curious about your thoughts around. I mean, it's a trend that's been there over recent years, but kind of the retailization of the private capital sector. The increasing importance of retail investors. What are your thoughts on that trend? Positive, negative, challenged. Just given your experience.
I think it's overall very positive. I mean, what we saw, what early days, particularly in my experience, even pre-Griffin, is you had a very small number of investment management firms making themselves available to the wealth space.
Hmm.
And as a function of that, the wealth space didn't necessarily focus on it. And so two things happened. One, you didn't have access the way you have right now. And two, you don't have competition. And I think with competition, what we've seen is really improvement in product structure, improvement in terms of the quality of the managers that are auditioning for capital in the retail
Sure.
space.
Yeah.
And so the investment diligence processes that we are now subjected to, the operational diligence processes are much more sophisticated than they once were. I think that's a great thing for investors. I think the cost structures have been narrowed in a way that's advantageous for investors and appropriately. So all of these things in terms of more transparency, lower cost, more rigorous diligence, I think those are all good things. And I think
Right.
just based on the structure of capital markets where, fewer public companies exist today and you have such a concentration in some of these indices among so few companies, having access to private markets does truly create pretty significant diversification.
Yeah.
But manager selection becomes significantly more important in the private markets than it does the public markets, just based on dispersion of returns across managers. So I think it's a great place to find out performance. I think a lot of the firms that have been thoughtful about how they provide this access to their clients on the wealth side have done a very good job screening managers, creating curated menus of sort of best in class across different sectors, and holding those firms accountable on an ongoing basis. So
Yeah.
I think it's been a phenomenal transition, and I think you're just going to continue to see more of it. Certainly, as it pertains to this administration's objectives and
Yeah.
allowing access into 401ks. So
Yeah.
uh, look, I don't think the train is slowing down. I think the investment, not just in, the investment management side of the business, but the ecosystem, right?
Yeah.
The investor portals, the reporting, all of those things being able to speak to each other, creating operational efficiency for investors, enhancements in tax reporting, will all make that experience better.
Yeah.
And create the infrastructure to effectively institute it in a way that investors have more positive experiences.
Yeah. I'm interested also in your thoughts, Nick, on you guys have a very well, curated and extensive distribution network, and you're working with a pretty broad range of distribution partners. What do you see happening in that space when you look at the, let's say, the strata of advisors from baseline kind of financial advisory firms to RIAs to family offices? Where do you see kind of the activity, and maybe this there's obviously references to things like a race to quality around financial advisory services, the growth in RIAs, the consolidation in that space.
Yeah.
What are you seeing when you look at the market in terms of, well, let's say relative to your market? What trends are kind of catching your eye?
So my personal view and the way that I think about this and communicate it to our folks internally is you need a reason for folks to need you, right?
Mhm.
They have so many choices of investment managers now and such high quality investment management firms.
Mhm.
What you do has to be differentiating, not just from a return perspective, but also from a support model perspective, right?
Mhm.
Particularly the part of the market where we're focused, which is heavily on improving financial planning, tax minimization, and investment outcomes, and being able to be conversant about those things to help the professionals we work with really understand how can they utilize these strategies to improve outcomes for clients, differentiate themselves compared to other advisors that might be talking to high net worth clients about these types of strategies. So you have to have a very well thought out and executed investment strategy, a very good support model that understands just the education that is required in order to help professionals be successful with the strategies that you have,
Yep.
and you have to communicate effectively, and not just communicate effectively with investors, but also the financial professionals and the research personnel. So you almost have three separate stakeholders all along that relationship. We understand that, and we value those relationships, and we treat them like gold because we're privileged to have them. And if we don't do a good job cultivating them, being successful within them, and supporting them, somebody else is going to be there. So it
Mhm.
is my view that you have to really understand the model and of your clients and be an important component in helping them achieve their objectives for their clients and for their firms as business owners.
Yeah.
So that's one component. The other component is it's really a race for shelf space. So if I'm a big registered investment advisor and an aggregator, and I have a research firm focused on alternatives, I only have so much bandwidth. And
Yep.
so, how many firms doing the same thing do we really need within our system if I'm sitting in their seat? And
Yeah.
you want choice and you want to pick the kind of top quartile managers. But in something like the opportunity zone fund space, you don't need four or five, you need, two or three.
Yeah.
And so, being able to meet them operationally where they transact is important. So if there's a platform that they are running their alternatives menu on, you
Yep.
need to be able to be there, right?
Mhm.
And so, making sure that we have that connectivity so that we can approach and talk to and position ourselves to talk to anybody is really critical.
Yeah. Yeah. When you look at the market you're in now, Nick, what are the potential concerns that you have that are maybe starting to present themselves or have the potential to present themselves given the kind of macro conditions that you described there? Are there any things that there's always something to keep you up at night, but things that's are of concern right now that you're kind of keeping a closer eye on?
Yeah, so, for the in the seat that I sit, I kind of look at that both inwardly and outwardly, right?
Yep.
So, as an organization, as we continue to grow, making sure that we have resiliency within the firm so that work is spread ratably, that
Mm.
we've got talented professionals and can give them the opportunity that they want to grow within the organization, to ensure that we have strong processes and workflows so that we can hold people accountable, making sure that we have a culture where people want to associate and continue to contribute to on a go forward basis. And then externally, I think about just positioning ourselves for the next opportunity. So as we launch this build to rent business, how do we want to go to market? How do we communicate to our partners why this is a part of the business we feel passionately enough about to invest significant capital in to make available to them? How do we differentiate all of the great work that we have done in the Opportunity Zone Fund space and why that experience matters? As I'm sure new entrants are going to come in now that there's a permanent
Yeah.
program, try and compete for that shelf space with our partners. So making sure we execute our current business well and that we're structured for continued growth in a way that's effective both internally and externally.
Yeah.
So to answer your question, it all keeps me up at night. It all keeps me up at night.
Yeah. Yeah, you mentioned, you mentioned, partners there. You seem to have a pretty partner-centric, kind of approach to, yes, part of your go-to-market, Greystar, I think Hanover, I saw in some of the notes. Um, when you're looking at development partners, what are you looking for? What are the kind of, let's say, must-haves or the non-negotiables?
Yeah. So we have both partner diligence and then investment diligence. And on the partner side, it's, you know, again, what does the track record look like? How well capitalized they are? Can we protect ourselves adequately in our joint venture agreements so that when things do go wrong, we're not disadvantaged? So, yeah, I think at this point we're established enough to the fact that we've got negotiated documents with our largest partners that we're comfortable with. And
Mhm.
so as we add new partners, we really take them through that sort of rigorous first turn process. And it's not for all of them. I think, in some respects, there are partners with whom they can negotiate more advantageous terms. Our view is we really don't want one-off partners. We want programmatic partners,
Yeah.
and we have stakeholders to whom we have to answer, and if they understand that, they're comfortable with that, then we can establish a long-term relationship. And it certainly gets easier in the last couple of years to establish these dynamics when capital isn't abundant, right?
Yeah.
So obviously it gives us an opportunity to negotiate more favorable terms, but we want to make sure that our partners view us as doing what we say we're going to do, and we want our partners we want to hold our partners to the same expectation.
Yeah. Yeah. Understood. And just kind of switching gears, then, if we look at the markets that you're focused on, so you've broken ground in St. Petersburg, Quincy. Um,
Yeah.
do you have a common thread that you look for when you're entering these markets? What's the?
Generally high growth markets,
Mhm.
good transportation infrastructure, well educated workforces, seeing population inflows, and really a spread between the cost to own and the cost to rent that skews heavily in favor of rentership. So, obviously, if that's the product that we're building and focused on, we want to make sure that there's a market for it. So it's generally kind of the eds and meds markets, right? Good education, good healthcare infrastructure, good technology growth, and investment. And Boston's a good example, right? Our deal you'd mentioned in Quincy, and it's a market I know well,
Mhm.
having grown up there, but
Mm.
very expensive housing market, very well educated workforce. But it not everybody can live down in the seaport or wants to spend $4,500 $5,500 a month on a
Yeah.
one or two bedroom apartment down there, right? So
Yeah.
if we can sit above Trader Joe's, which is a great amenity, which we will there,
Yeah.
uh, right next to the Red Line, which takes you straight into downtown, uh, and we're 15 minutes outside of the city, but $1,000 to $1,500 a door cheaper, then we're comfortable with that. So what are the market dynamics look like? What are the site location dynamics? And if we can put all of that together in a thesis that we're excited about, then we've got something that hunts.
Yeah. Slightly controversial question here, Nick, but I know this just from conversations I've had with various operators in the OZ space. Um, this this challenge with potential gentrification.
Yeah.
When you're investing in these areas, I mean, what's your view on that? I mean, is it a real, I wouldn't call it accusation, but is that something that you're seeing on the ground, or how would you respond to that?
So I
With
think it depends how you approach it, right?
Mhm.
One, we're not taking existing housing out of stock and replacing it with higher cost housing. I mean, so in these urban locations, these were retail centers that had gone dark, where it wasn't their highest and best use, whether, yeah, in some cases it was a service parking lot, right?
Yeah,
So highest and best use wasn't a parking lot, it was housing in these communities. But I think what we know for a fact when you look at the OZ is the cost of the subsidy is about $23,000 a door, which is way, way, way more effective than other types of tax incentives that you've seen to develop housing.
right.
So the program has been tremendously effective in creating housing, particularly as you look at the cost to do so. That's number one. Number two, every housing economist in the universe that is credible, which is most of that, will tell you that the way to create housing affordability is to create more housing. And we've seen it, right? As we've seen all these new deliveries in the market over the last 18 months, rents have gone down or flattened. So,
Right.
what we know for certain is that when you add housing to these communities and create more options and accessibility, then housing costs come down. And so, most people want to rent in places they couldn't normally own, right? They want proximity to their workplace, they want proximity to amenities. And when you create more product and more choices in these markets, you create more affordability within these markets. So it's been effective in terms of the cost of the subsidy. It's been effective in terms of creating more housing, which makes housing more affordable. And all of those good things outweigh some of the detractions that I've heard.
Yeah. Yep. All right. Good to get that perspective. Um, just as we're coming to close here, we think about the range of offerings that you guys have, right? That you've taken to market. Where are you seeing the kind of demand pockets across your target investors? Is it income, tax alpha, total return? I mean, what is it that let's say if I'm looking at Griffin Capital, I should be thinking, well, this is probably a good place to stop if I'm interested in X.
Yeah, so look, it's changed over time
Hmm.
as broader and market opportunities have changed, right? So the way I think about investing personally is it's all about relative investment choices. So if I can earn a stated rate of return in a way that is more liquid, and lower risk than in another way, I'm going to gravitate that
Yeah.
way, right?
Yep.
So when rates were low and fixed income was not generating a lot of yield and retirees were looking for more return in that part of their portfolio, we saw a lot of inflows into our registered funds. We saw a lot of inflows just in the business into open-ended private real estate vehicles because the yield was outsized relative to traditional markets. As interest rates have gone up, as that's been challenging for real estate, people have rotated. Where our investors really come to us, generally speaking, is either growth, diversification,
Yep.
or solving an issue. So I have a capital gain, whether it's the sale of real estate, and I want to effectuate a 1031 transaction because it was investment property.
Hmm.
Then we're a solution for that. If it's I'm selling a business or I've got highly appreciated concentrated equities and I want diversification, then the opportunity zone fund becomes an interesting construct for that. So it's really right now solution oriented for clients as opposed to because they've had an event that they're trying to solve for,
Yeah.
as opposed to I need more juice out of my traditional fixed income allocation and therefore I'm willing to take on a little bit less liquidity and a little bit more of a risk asset exposure into income producing real estate. That trade is off. So our clients are either growth focused in our development funds today, or they're solving a tax driven problem with a 1031 exchange or an opportunity zone fund investment.
Yeah. Yeah. Okay, great. And just kind of in closing, Nick, looking forward for the next couple of years, there's a couple of themes we talked about, kind of, and new developments, right, around OZ, around, the inclusion of 401k as as a source of capital. What tailwinds are kind of most exciting for you over the next couple of years as you look at Griffin's business?
Yeah, I think just when I think about rental housing,
Hmm.
which is our core investment business today, it's population demographics and operational tailwinds. I mean, we've underproduced single family housing for an extended period of time, and we can't solve that problem overnight. So we do know that we have a very deep, very sticky rental pool. Younger cohorts and older cohorts are increasing their propensity to rent and rent longer. So the ability to create, communities for these folks in the markets that they want to live that meet their lifestyle needs, I think is really exciting for us. Number one, number two, because we have been in an environment where new starts have declined dramatically, we do expect to have operational tailwinds over the next several
Right.
years. So to be able to be executing our core business with some wind at our back, is going to be a welcome transition, certainly relative to the last 18 months.
Sure, sure. Great. Well, let's leave it on that positive note, and I echo that. It is great to see it. Finally, we're seeing these green shoots. Nick, thanks so much for taking time out. I know you guys have a ton going on right now. Really appreciate your insights. And I should full disclosure, you're a valued client of ours. We're delighted to be able to work with you and the rest of your team. It's been an absolute pleasure so far. But for today, here on the People of Private Capital podcast, Nick Rosenthal from Griffin Capital, thanks very much for your time.
Great to spend time with you, Ferdy. Thanks very much.
Thanks, Nick.